Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Nisource Inc. Annual Report. Nisource Inc., a leading energy holding company, offers a diverse range of services to residential, commercial, and industrial customers across the United States. The company operates through two main segments: Columbia Operations and NIPSCO Operations. At its core, Nisource provides natural gas distribution services, covering approximately 37,300 miles of pipeline and individual customer service lines in 5 states: Ohio, Pennsylvania, Virginia, Kentucky, and Maryland. This extensive network enables the company to supply natural gas to a significant number of customers. In addition to natural gas distribution, Nisource also generates, transmits, and distributes electricity to over 0.5 million customers in northern Indiana. The company owns and operates various power plants, including steam coal generating stations, combined cycle gas turbines, natural gas generating units, hydroelectric facilities, wind farms, and solar energy installations. Nisource's services extend beyond retail sales, as the company also engages in wholesale electric and transmission transactions. This comprehensive approach to energy provision makes Nisource a significant player in the U.S. energy market. Unfortunately, I am unable to provide a response, as I do not have access to the text you provided. Please provide the text so that I can assist you with generating an overview essay on what has caused Nisource Inc.'s stock price to increase in the past year. However, if you would like me to generate a general essay on factors that could cause a company's stock price to increase, here is a possible response. The stock price of any publicly traded company can fluctuate based on various market and economic factors. One key factor that contributes to an increase in stock price is the company's financial performance. When a company reports strong earnings, revenue growth, and increased profitability, investors tend to be optimistic about its future prospects, leading to an increase in demand for its shares. Another significant factor influencing stock prices is industry trends and market conditions. If a company operates in a growing or emerging industry, its stock price may rise due to the increasing demand for its products or services. Additionally, changes in government policies, regulations, or tax laws can also impact a company's stock price positively if they benefit the business. Furthermore, investor sentiment and market psychology play a crucial role in determining stock prices. When investors become optimistic about the economy or a particular industry, they tend to invest more in stocks, driving up their prices. Conversely, when investors become pessimistic, they sell their shares, causing prices to decline. Lastly, mergers and acquisitions, M&A, can also impact a company's stock price positively if it leads to increased revenue, cost savings, or access to new markets and technologies. When a company acquires another business, its stock price may rise due to the potential for increased earnings and growth opportunities. In summary, various factors contribute to an increase in a company's stock price, including strong financial performance, industry trends, government policies, investor sentiment, and M&A activities. Nisource Inc. maintains a market capitalization of $22 billion, broadly in line with the industry peer group. Nisource Inc. trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 2.31 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 2.63%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through various factors. On the revenue growth side, tariff-based sales, customer usage and payments, and balancing and exchange arrangements of natural gas contribute to increased revenue. Additionally, cost recovery mechanisms such as regulatory assets and liabilities related to gas costs and fuel adjustment clauses also play a significant role in revenue growth. On the other hand, revenue decline drivers include unrecognized pension and other post-retirement benefit costs, deferred pension and other post-retirement benefit costs, environmental costs, and regulatory effects of accounting for income taxes. Furthermore, under-recovered gas and fuel costs can contribute to revenue decline. Other factors that impact revenue growth or decline include commodity price risk management, rate refunds, renewable energy investments, and customer assistance programs. Tax payments also play a role in revenue growth or decline, with decreases in Pennsylvania, Virginia, and Ohio tax payments contributing to revenue decline. Segment revenue analysis shows mixed results, with Columbia operations experiencing external revenue growth, while NIPSCO operations experienced a decrease. Overall, the drivers of revenue growth or decline are complex and multifaceted, influenced by various factors such as customer usage, regulatory mechanisms, environmental costs, and tax payments. The company's net income and profit margins underwent significant changes between 2023 and 2025. Initially, the net income decreased by $129.7 million from 2023 to 2024, but then increased by $167.9 million from 2024 to 2025, resulting in a total increase of $370.3 million over the two-year period. The profit margins also experienced changes during this time. The operating income margin rose from 23.5% in 2023 to 27.7% in 2025, indicating an improvement in operational efficiency. However, the net profit margin decreased slightly from 15.5% in 2024 to 15.2% in 2025. The reasons behind these changes can be attributed to various factors. The increase in revenue was largely due to colder weather conditions, which boosted sales. On the other hand, the company faced higher operating expenses, including depreciation and amortization expense, property tax, employee-related expenses, and cost of energy billed to customers. These increased costs contributed to a decrease in net income margin. The company's debt level has undergone significant changes over the past few years. According to the extracted summaries, the total long-term debt increased from $13.36 billion in 2024 to $15.48 billion in 2025, representing a substantial increase of approximately 16%. Furthermore, the revolving credit facility limit was raised from $1.85 billion to $2.5 billion in December 2025, indicating an expansion of the company's borrowing capacity. In terms of interest expenses, there has been a notable increase as well. The net interest expense rose from -$517.2 million in 2024 to -$639 million in 2025, representing an increase of $121.8 million. Additionally, depreciation and amortization expenses increased from $1,043.2 million in 2024 to $1,167.6 million in 2025. Overall, the data suggests that the company's debt level has increased significantly, accompanied by a corresponding rise in interest expenses. The performance of the company's segments varied significantly across different regions. The NIPSCO operations, based in northern Indiana, stood out as a well-performing segment. It generated substantial revenues from residential gas service and electric generation and power delivery, with total customer revenues reaching $2,654.5 million. Moreover, its operating income increased by 51.2% to $938.1 million. In contrast, the Columbia operations, covering Ohio, Pennsylvania, Virginia, Kentucky, and Maryland, struggled to match NIPSCO's performance. Its gas distribution revenue was lower than NIPSCO's, with residential, commercial, industrial, and wholesale segments underperforming. The segment's operating income also decreased by 14.9% to $895.1 million. The poor performance of Columbia operations can be attributed to its lower electric generation and power delivery revenues compared to NIPSCO. Furthermore, the decrease in operating income from $904.7 million in 2023 to $895.1 million in 2024 indicates a decline in profitability. Overall, while NIPSCO operations excelled, Colombia operations faced significant challenges in terms of revenue and profitability. The company's management is optimistic about its outlook, emphasizing the execution of electric generation transition plans. This includes investing in renewable energy projects such as wind and solar facilities to reduce reliance on traditional sources. Management also highlights the importance of complying with regulatory requirements, managing risk through a multifaceted process, and addressing environmental issues in cooperation with authorities. A key aspect of the company's strategy is its significant capital investments, totaling approximately $21 billion during the 2026-2030 period. This investment will focus on developing contract assets in connection with the ADS contract, as well as other initiatives. The company also has regulatory assets worth around $499.3 million that will be recovered over a period of 50-75 years. Overall, management's outlook suggests a commitment to sustainability and compliance, while also driving growth through strategic investments. The acquisitions made by the company include several strategic partnerships and investments. One notable acquisition is the Templeton project, acquired through a build-transfer-agree (BTA) structure. Additionally, the company has entered into a power purchase agreement with Genco to meet demand under the ADS contract. Other significant acquisitions include the construction of 400 MW of new battery storage and two 1,300 MW combined cycle gas turbines. The company has also made several investments in various projects, including the Fairbanks project, Dunn's Bridge II project, and Gibson project. Furthermore, a partnership with ADS is mentioned, although no specific details are provided. The company also plans to explore potential partnerships with other large data center customers and engage in strategic mergers and acquisitions. On the other hand, the divestitures made by the company include the retirement of coal units at RM Shofford Generating Station and Michigan City Generating Station. Additionally, two natural gas-fired peaking units at RM Shofford Generating Station are set to be retired. The company's net zero goal also includes the retirement of NIPSCO's coal facilities. The company's commitment to shareholder value is evident through its consistent payment of dividends. As stated on page 44, the company has declared quarterly cash dividends on common shares, demonstrating its dedication to returning profits to investors. This practice has been ongoing for several years, with notable examples including a $530.4 million payout in dividend payments for 2025, page 77. Furthermore, the company's policy of declaring cash dividends on a quarterly basis, page 99, underscores its commitment to providing regular returns to shareholders. The payment of dividends is a clear indication that the company values its investors and is committed to generating long-term value. Concerns about inventory buildup or supply chain disruption. There are valid concerns regarding supply chain disruption in the industry. Multiple pages highlight potential issues such as shortages or delays in obtaining equipment, natural gas bans or restrictions that could reduce demand and increase customer attrition, lack of diversity in suppliers, and increasing delivery lead times. Additionally, global shortages in raw materials, transportation logistics issues, decreased construction labor productivity due to material unavailability, and fluctuations in commodity costs for gas and electricity are also mentioned. These concerns suggest a high risk of supply chain disruption that could impact the ability to timely restore services. Furthermore, potential lack of control or visibility into sourcing by vendors, risk of operational failure, reputation damage, and commercial losses due to delayed deliveries and shortages from third-party suppliers add to the severity of the issue. In contrast, there are no significant concerns about inventory buildup in the industry. This suggests that while supply chain disruption is a pressing concern, inventory management appears to be under control. That concludes the financial summary for Nisource Inc. Feel free to comment below, and I will be happy to answer them when possible.